How to invest in an overvalued market. Hey guys, today we're going to talk about how to invest in an overvalued market. Let's get right into it. Number 1. Raise cash. If investors are concerned about overpriced markets, they can always go to cash and hope for a crash. Stocks do not have to fall from their current levels, but it is always possible. The security of cash appears to be a wise strategy, but there are 2 caveats. For starters, you may miss out on additional gains. Since 1937, the S&P 500 has averaged 25% gains in the 12 months preceding market peaks. If you go to cash in the hopes of calling a top, you must be prepared to watch a meltdown from the sidelines. Because cash yields next to nothing, the relative performance difference in this scenario would be enormous. Second, when it comes to market timing, you must be correct twice. Once when you exit, and once when you re-enter. No one can call tops and bottoms on a consistent basis, so there should be rules in place to guide your actions and tell you when to get back in. Sitting on the bench can be psychologically taxing. When you're out and the market begins to fall, there will always be more reasons to stay out. When you exit the markets, holding cash can become an addiction. Number 2. Overweight bonds. Similarly, in their portfolio, investors could underweight stocks and overweight bonds. A bad year in the bond market is similar to a bad week in the stock market, but with lower interest rates, bonds will likely experience much higher volatility and lower future returns. Number 3. Own more overseas stocks. According to a Vanguard paper, US investors have nearly 80% of their equity exposure in US stocks. This home country bias has benefited investors in recent years, but markets outside of the United States are now much cheaper as a result. Investors concerned about US valuations can find better value in foreign developed and emerging market stocks, but doing so requires many to invest outside of their comfort zone. Number 4. Make your asset allocation more tactical. Following the financial crisis, investors became more accepting of tactical asset allocation as a means of mitigating drawdowns or volatility. The difficult part of becoming tactical is that valuation is usually a bad signal to use as a timing tool. Mean reversion rarely follows a predictable pattern. Stocks are driven more by sentiment, trends, and momentum than valuations in the short to medium term. So overvalued markets can always become more overvalued, and undervalued markets can always become more undervalued. Consistent process to remove your emotions from the equation. Because nothing works perfectly in the markets, you must accept that you will always be on the losing side of a trade in any tactical model. This type of investing necessitates paying insurance premiums on occasion by buying or selling at the wrong time and getting whipsawed by jumping in and out. Number 5. You could be worried about the wrong thing. Begin by going over the fundamentals of your investments. According to Rod Holloway, equity portfolio manager at Comprehensive Financial Consultants in Bloomington, Indiana, this includes the return of equity, price-earnings multiples, and growth rates over the last 3 years. He cautions, however, against relying solely on 3 metrics, as this can lead to a false sense of security. According to Holloway, even if the fundamentals look good, you should still look at how far above certain key moving averages a stock is trading. This, he claims, is a good way to see if there is a short-term overvaluation. Examining historical data can also assist you in identifying overpriced investments in your portfolio. Anthony Saglenbean, an Ameriprise financial global market strategist based in the Greater Detroit area, says a good rule of thumb is to look at valuations over multiple trading periods and over full market cycles. According to him, overvalued investments can be identified by exhibiting outsized price gains in relation to their fundamentals and overall business conditions. While stocks may receive the majority of your attention, don't overlook overvaluation in your other investments. Bonds, according to John Traynor, Executive Vice President and Chief Investment Officer at People's United Wealth Management in Bridgeport, Connecticut, are currently more overvalued than equities. Traynor says, "We compare equities and bonds to several benchmarks over the last few market cycles, and while equities are expensive, we believe bonds are in rare territory with such low yields. Relative to economic growth and inflation, bonds may be more concerning than stocks, especially if the Federal Reserve continues to raise interest rates." Number 6. Time is your most valuable asset. Don't be alarmed if you've identified some potentially overvalued segments of your portfolio. Consider your overall investment strategy, as well as how long you have to ride out a market downturn. According to Rusty Vanneman, Chief Investment Officer at CLS Investments in Omaha, Nebraska, your investment goals will ultimately determine the time horizon. If your long-term investment strategy is based on your goals and risk tolerance, you may be better off doing nothing and ignoring the overvalued market. Vanneman said, "The markets are inherently volatile, but there's a strong tendency to produce positive returns, more so than playing it safe in cash. If the market is making you nervous, keeping some of your investments in cash can be a good defensive measure. But it's not a good idea to abandon stocks entirely. Overvaluations can be beneficial if you have a longer time frame to invest. According to David Hayes, president and founder of Comprehensive Financial Consultants, time is the most valuable asset of an investor. If you have 30 years until retirement, a market correction can be beneficial. Because you can buy stocks at a discount, the issue is that far too few investors are taking advantage of the price drop. That's all for today, and we'll be sure to catch you all in the next one.